Hello, everyone. Welcome back to part two of our discussion of partnerships and their taxation. Well, not their taxation, but really what happens to partners in the partnership from their taxation, because Form 1065 is what a partnership is required to file. It is an information return, meaning it's not really a tax return, because you'll see no place on the form for calculating the amount of tax to be paid. So the partnership's not paying tax. Everything is going to be in turn reported on the return of the individual partners, which could be other partnerships, could be individuals, could be corporations. Very flexible, which is the best thing about a partnership, you might say, is the flexibility. Now, this Form 1065 is also used for limited liability companies and limited liability partnerships, which are newer entities that provide more protection for individual who are in their members is what they're called in a limited liability company. They serve and work the same way and basically have the same responsibilities as a partner in partnership, which is why they use the same form. This is due on March 15th or the 15th of the third month after the end of the year. You can get an automatic 6 months extension with Form 7004. These 1065s send a K1, have a K1 for each partner that they file, and then they send a copy to each partner as well. So just like your W-2 at the end of the year, your employer sends a copy to the IRS, actually the Social Security Administration, but sends it, passes it on to the IRS, and they send a copy to you. So what's going to happen? It's going to get matched up. That's the idea. The K1 is the same thing. That shows what income was earned by the partnership on behalf of each partner. K1 then comes to the partner, and then they're responsible for putting the items that they see on the K1 on their tax return, on their 1040. So, a little bit more about some of the separately stated items. If it has to be treated differently at the individual partner level, then it must be separately stated. There's a list in your textbook. These are ones you should remember us discussing earlier. Rental income, we know that that is assumed passive, and you can only use it as loss or if you have other passive, all those kind of things. Those special rule type areas, interest, dividends can be ordinary, they can be qualified, and their tax rates will be different depending on what the situation is with the individual partners. Capital gains and losses and all those we've talked about earlier. Those are all separately stated items. So they have like their own listing on the 1065. So you count. First page of 1065 is literally an income statement, shows your ordinary income. Next page, there's some information, and also then it starts to break down these separately stated items. And there's literally a list on the Schedule K of the 1065. And then the parts or the percentage that represents that particular partners goes to the K1s. And so the K1 will have ordinary income for the partner. It'll have each of the partners part of the separately stated items. So if they're a 30% partner, it'll be 30% of the total. Okay? And each of their lines, their numbers, corresponds to what is reported in the 1065. So, what constitutes self-employment income? So, technically, a individual as a partner cannot or should not be an employee of the partnership. So their income is, if they're a regular partner, if they're a general partner making decisions for the partnership, their ordinary income is self-employment income. Guaranteed payments are self-employment income. If you had any Section 1231 that was included in ordinary income, you can subtract that out, and you can subtract your Section 179 in calculating self-employment income. And from our calculation of self-employment income and then self-employment tax, you'll see that's a kind of a important key. You want to make sure that to reduce your tax liability, to make sure you include as much as you can in calculating your self-employment income. So this is just some ways to check that you're understanding. Why are these special items? Because they each get treated differently at the partner level. For instance, the example of you can only use so much of the capital losses and the rest has to be carried forward. That could be, each partner may have that same rule, but one may have other capital losses, other capital gains, so they have to be broken out. You cannot just lump it in with the rest of the income. And then, of course, calculation is important for calculating your self-employment income. Now, we talked about basis in the partnership. That original basis when you put money in, your contribution, start with the basis of property contributed, plus any services rendered, fair market value, or if you bought the partnership share from another existing partner, that would be your cost. That would be your starting basis. All right. Now, if you may put more money in later, that would be added to your basis. You then are going to increase it by any part of the ordinary income. You're going to increase it by your part of the separately stated items. You're going to increase it by the share of your partnership liabilities. That's the thing that we tend to forget. The share of partnership liabilities. And liabilities go up, we actually increase our basis. That seems a little counterintuitive, but that is the rule. If you think of it as that's money because it's a liability of the partnership that you as a partner would have to pay, you can think of it as money that is actually at risk, and that's really what we're dealing with, is what is at risk. Notice that it says any separately stated items, some things are non-taxable, tax-exempt income, that sort of thing. Some expenses for the business are not deductible, like meals, only half of it and stuff like that. Doesn't matter. They still change your basis. Doesn't matter if they're taxable or non-taxable. Doesn't matter if they're deductible or non-deductible. They still change your basis. Anything comes out of the partnership reduces your basis. If you lose money in the partnership, it reduces the basis. Okay? And if the liabilities go down, then it reduces your basis. So those are all of the things that can change, and you have to look at those when you're figuring out what the basis is. You have starting basis, and then over the year you have all of these things, and then you'd have an ending basis, which then carries over to the next year. All right, what about distributions? Money coming out of the partnership to the partner. Generally, just like putting things in, there is not going to be a gain or loss unless it is a liquidating distribution. So any non-liquidating distribution, liquidating distribution means for the whole part of your partnership share. The partnership is giving you something and you are no longer a partner. Okay, that would be a liquidating. Anything other than that is a non-liquidating distribution. This is money distributed to the partner. Notice it is not what determines the tax to the partner. The partner is reporting income as the partnership earns it, not based on distribution. So the distribution itself is a non-taxable event, meaning it's not income to the partner. And the distribution itself is usually not going to have a gain or a loss. Only if the amount of money or securities you distribute is more than your basis. If it's other assets, it is not going to give you a gain. Okay? Or if you distribute to a pre-contribution gain property, and that's property that you contributed to the partnership. For instance, our example back where we contributed $50,000 of land that had basis to us $50,000 worth $100. That's a pre-contribution gain. If we then turn around and distribute that land back out to another partner, we could have gain because it's looked at as kind of a way to transfer property around without recognizing gain, and that's not looked at favorably, but pretty rare, so not something we're going to spend a lot of time on. Okay, so this is the definition of pre-contribution gain. What we need to worry about is the basis of distributed property is typically the same as when we put it in. The basis carries over. So the property that's being distributed, if it's other than cash to the partner, carries the basis it had inside the partnership to the partner. So look. So a couple of questions to check ourselves. Which of the following is true concerning recognition of gain on a distribution from a partnership? Okay. Only if the gain is if the partner received cash in excess of his or her basis. Okay. Another example, Nelson has partnership basis of 12, receives a partnership a distribution with of 16,000 and fair market value of 10. Okay. Nelson's basis in the furniture after distribution is, okay, $12,000, his basis in the partnership. So he receives the furniture in return for his partnership basis, and that's the partnership share, and that's what his basis becomes in that new property. No gain or loss. Okay. In this case, he also received cash of $4,000. All right. Now his basis in that furniture is being reduced by the 4,000. So instead of being 12, it's 8,000. Okay. So that's the difference if there was cash involved. Liquidation, disposal, or liquidation of a partnership interest. This means we're going out of business or a partner is leaving altogether. It can have a loss, but in only very special circumstances. If you get more than your basis, we get a capital gain. It is a capital gain. We sell our partnership share to someone else. It's a capital asset. We get capital gain. If we are basically being bought out by the partnership, it's a capital gain. All right. If you simply get the amount that you have as basis, then you obviously don't have any gain or loss. So if you sell it to, again, like we said, someone else, treat it as a sale, unless there is inventory or accounts receivable. Some of it could be ordinary. That's a fairly complicated discussion that we probably won't get into here, okay? But just like if you sold any other capital asset, you would report it on a Schedule D to the 1040. All right? So, Shelley has basis in partnership interest $30,000. She receives following assets in complete liquidation. All right, so she gets cash, inventory, equipment, land, and the basis is listed each one of there. So she gets 15, 23, 35,000. All right, so she's going to have a gain of 0 because remember, the only time you get a gain is if you receive cash in excess of your basis. She did not. Her cash is only 9,000. All right. So she gets the basis as follows: $9,000 in cash, inventory, the 6,000, and then she splits the rest of the basis between equipment and the land. All right, based on that ratio, kind of split it up. So she ends up with basis in her these assets of a total of what? 30,000, just like she had basis in her partnership interests. So she becomes, instead of having $30,000 worth of partnership interest, she has $30,000 worth of assets. The ones that have a specific way to have to be handled are cash and inventory. The others get split up based on their values. And our last look at this, Callie purchased 60% partnership interest for 55, income 1826. So she made no additional contributions or withdrawals during this time, and she sold for 107. So her basis, you just start with the 55, you add the 18 to the 26 because those are partnership earned income or ordinary income that gets added to our basis. So our basis becomes 99. We sold it for 107. We have an $8,000 gain. It's a capital asset. There's no mention of inventory receivables in the partnership. So otherwise you could have some that is ordinary income.